Hello traders, this is lesson number 5 of our swing trading course. Today we're going to talk about how big to trade. So position sizing, that is so important and so many people don't really look at it, and that's why many of them blow up accounts. But if you follow this course today, you won't. So let's start. That is a skill. Position sizing is a skill that keeps you in the game of trading, because what's the main objective in trading is to survive long enough. You know how they say there are old traders and bold traders, but there's no old and bold traders. So let's see how we can achieve to be an old trader, to survive in the game long enough. So position sizing is what decides whether you're stressed and emotional in trading or not. It's that important. So it is not negotiable. Position sizing is super important because it's going to help you to control your emotions, limit the damages from the losses, and keep consistent results. And first of all, the main thing is it prevents you from blow up your account. So two traders can have the same trades. They put on the same trades. They have same setups. One of them is going to survive a losing streak and the other one won't. Why is that? Every one of us are going to have losing streaks. All of us, at all time, every time. It's not something you can avoid in trading. But how you survive a losing streak is completely different. So that's why position sizing is non-negotiable, because that's what is going to keep you afloat when you have a series of losses, which is going to happen 100%, all of us. All right, so we need to define, first of all, the risk per trade. In our account, we need to understand how much we're risking per trade, okay? Between 0.5% and 1% per trade is considered conservative, right? But there's some people that are not okay with 1%. It's already too big for them. So for some other people, it might not be conservative. Then you have 1% to 2%, moderate, and rarely more than 2%. I would never suggest anyone to go more than 2% risk per trade. Because if you're wrong 4, 5, 6 trades in a row, you're going to blow up your account. So it's really, really important to not go more than 2%. Now, am I telling you to put on trades at 2% risk per trade? Absolutely no. I will be conservative and go for 0.5 to 0.75, max 1% per trade, because this is what really helps you to have peace of mind and, reduce the chances to blow up accounts or be emotional. So this number is absolutely personal. Once you choose the number, you need to stick to it without deviating. Right, now let's understand why small risk works better. So if I am risking a little amount of money, if I have one loss, I'm not going to be too worried about it. Doesn't really matter. Drawdowns are manageable. So if I'm losing, $100, $200 per trade, and I'm losing like 4 or 5 times, you're not going to be in a crazy drawdown. It's manageable. You can definitely get out of it and start making money again. And also, more importantly, you can execute without fear. If you put on a trade that accounts for like 30% of your account, you're going to be scared of that trade. You're going to be emotionally attached to that trade. It's not going to be good for you. It helps you to stay objective, because when there's not too much money on the line, you can think clearly. So if one trade can emotionally ruin your day, it means you're risking too much, and you know that you are. Now, how do we calculate position size? First of all, we need to understand where's our stop, okay? So the position size depends on the distance from the entry and the stop. Not how good the setup looks, not how you feel that day, and not because you've been winning recently. So you say, okay, let me decide position size based on like a stop loss that came out of thin air. I don't really have a reason why I want to put my stop there. So that's not good. But we know that the distance between entry and stop will determine our position size. Now, if we have a wider stop, we need to have a smaller position. if you have a tighter stop, you can have a larger position. The risk stays the same. But let's get more into it. Now, we need to talk about, first of all, the position size formula. Just remember this formula for now. So position size is account risk divided by trade risk. So the account risk is the percentage of the account you risk, which what we just talked about, 0.5%, 1%. So it's the percentage of the account you're risking. And the trade risk, as we said before, is the distance between the entry and the stop. So this, in this red box, is your trade risk. Before moving on, we need to understand what average true range is. So remember the formula, but now let's get into ATR, average true range, what it is and what it measures, because we're going to need it moving forward. So the ATR measured the average daily price movement, the volatility, not the direction of a stock, only the movement. So you will see, like in any brokerage, you open TradingView, for example, you go on indicators, you type ATR, and that's what you're going to see. Okay. So if the ATR, like in this example, is 1.79, this means that the stock typically moves about 1.79 per day. Remember, this doesn't tell us if the stock is bullish or bearish, and it does not predict direction. It just helps us to understand how much the stock moves daily, okay? And it gives also an indication of volatility. So we see ATR going down, means volatility is going down, it's decreasing too. If it goes up, like momentum is picking up, volatility is going up. So the ATR measures only the average daily price movement and nothing else. So let's understand how we're going to use it, how we think about this. If the ATR is, for example, 1, usually the stock is calm, has small daily moves. It doesn't have crazy movement, okay? It's not like, an NVIDIA stock or Microsoft or Amazon. It's like more calm stock that has like a smaller daily move. If we have like 3 ATR, it's pretty good movement, moderate movement, or still, I would say pretty good. $6, these are big daily swings. Like you're on a swing and you're swinging a lot. That's a lot. So big stocks, they're very volatile and they move a lot per day. So we use the ATR that we just learned about to place our stop. Okay. So for a bullish trade, our stop will be the entry minus the ATR times 1.5. And I will explain why 1.5. For a bearish trade, is the stop equals the entry plus the ATR times 1.5. Okay. Why are we using 1.5? Because the ATR times 1 is often too tight. Okay. So normal noise can hit it. You put the stop at just one time ATR, it's likely to be hit. Okay, because it's too tight, literally too tight. If we multiply the ATR by 1.5, it gives us a bit more of breathing room. Okay, so that's what we're going to use as a rule. ATR times 2 might make the stops too wide and your risk grows too much. So 1.5 is the perfect balance between protection, because you don't risk to get whipsawed or stopped out too much, and being realistic with it. Now, this rule for our stop, it's just a rule that we have and it works pretty well. But the exact stop location, you also need to keep into consideration the structure, the chart. But the ATR, in this way, it helps us to set the risk band. So how much you could expect the stock, for example, to pull back here, okay? It gives you enough room to not be stopped out too often. But again, we need to mix it together with market structure and the chart. So for example, here we had a stop ATR 1.5, but it's also on a 20 SMA. It's also on previous resistance that became support. So we need to consider a few things. But it's easy for us to think and quick to calculate our stop if we go ATR times 1.5. Now we go back to the position size formula. Now that we check what's our ATR, what's our risk, let's go back to the formula. So the trade risk per share, so the amount that you lose per share if the stop hits, we said is ATR times 1.5. Then we need to consider the account risk, which we already checked before. So 0.5 is conservative, 1% is a standard, 2% aggressive. We should go for 0.5, especially if you're at the beginning of your trade, you don't want to risk too much. So that takes us to the formula. So position size is the account risk divided by the trade risk. So the account risk is the account size times the risk in percentage, and the trade risk is the ATR times 1.5. So this is the formula for our position sizing, for how much money we're putting on the line. Let's make now an example. Okay, we have an account of $20,000. We decide to risk 1% per trade. So this means that we're risking $200. So we're comfortable. We wake up that day, we put on the trades thinking, okay, I'm comfortable with losing $200 and no more than that. Okay. That's what I decide in advance. That's my risk per trade. I don't want to lose more than that. So if we have this stock and the entry of the trade is 100 and the ATR we check on the chart on our indicator is 2, our stop loss will be at 97 because the ATR times 1.5, so 2 times 1.5 is 3. So the stop is going to be 100, our entry, minus the trade risk, which is 3, and that gives us to our stop loss at 97. Okay. Now we can understand how many shares we're going to buy, because we said that we only want to risk $200. Today we woke up and we said, okay, my risk is $200. I'm risking 1% per trade, and that's always has to be the same. But today I'm comfortable with risking $200. So how many shares of this stock I can buy to risk only $200 in this situation? You can only buy 66 shares. Okay, so $200 divided 3. So it's your risk per trade divided your risk, the trade risk, gives you, this is our position size formula, it gives us how many shares we can buy, 66 shares. So if I only buy 66 shares with this entry or with the stop loss, I'm risking only $200 in case I'm wrong on the trade and the stock pulls back and so on. So the great thing about position sizing is by knowing all of this in advance, you know that this trade cannot hurt you. If you're wrong, you're losing $200 and you already know that and you're comfortable with that. I mean, think about it. When you know all of this and you're comfortable with the losses, you execute without fear. The emotions are out of the picture. And that's how position sizing is important. So important. That's it for today. Thank you, and I'll see you next time.